again, but the tailwinds should prevail later this month. Joining us is Fundstrat's head of research, Tom Lee. Tom, you always give a short-term tactical trade around the inflation number. So we get CPI next week. What do you think it's going to show, and how do you think the market's going to react?
I think next week's going to be a turning point for markets in terms of people being more confident that inflation is tracking lower. I know you mentioned services, but keep in mind that by far the biggest piece of services in CPI is housing. And I think that's where the market's thinking is changing because, when you look at realized rent indices, which came out and showed actually it's declining now, or the fact that more Fed officials are talking about trying to apply shelter real time rather than backwards looking, I think really the story is inflation is tracking lower than expected. And I think that helps. The selling that was front-ended this month is going to turn into some buying, maybe starting today, but really beginning next week.
So you have a new call here on tech and the NASDAQ in particular?
Well, I think the sell-off in the NASDAQ, especially because it does seem like it was led by the Apple and the China developments and the potential risk of losing some sales there, that's going to prove to be a buying opportunity because for many reasons. But one, Apple is a structural partner to China. So I don't think Apple is going to face the type of risk that many are worried about. But more importantly, if inflation is falling and companies are becoming more confident, and we already know corporate profit revisions have been positive, that's going to get investors more confident adding equity exposure, but they're going to want to have exposure to companies like the mega cap tech. So I think this is going to be a buying opportunity.
I wonder, Tom, why you think the consensus seems to be that there will be a cut, at least in some point in the middle of next year, and yet rates don't reflect it yet. Is that a suggestion that the roll-off in inflation, if it happens, is going to be sudden and dramatic?
Carl, it is one of the mysteries of the market. To me, the market doesn't always make sense. And what you're highlighting is two things. One is we know the Fed doesn't want to necessarily apply more pressure to the economy. So if inflation is, let's say, 2.7, 2.8 next year, and Fed funds stays at 5.5, that's extremely restrictive. So it makes sense for rates to come down. But at the same time, the 10-year yield has been drifting higher. I think that reflects the unknown if that's because of term premia changes or the neutral rate changes or just the sheer skepticism, because I know a lot of folks are saying, well, even if August CPI is good, that's 3 good months. What makes us think it's repeatable? And I think that as long as that's the question, and as long as the Fed expresses that skepticism and looks backwards, I just think interest rates reflect the uncertainty about the path of monetary policy. I think that's going to change by November.
What about labor? I mean, we kicked around Walmart yesterday, trimming some wages for new hires out of the Journal. Obviously, everyone talked about participation in the last NFP print. Is that a tailwind to your thesis?
Yes, it is, because I think at the start of this year, people said labor markets are so tight that wages are going to spiral upwards in a runaway fashion that fuels more inflation. We're seeing the opposite. The unemployment rate has kind of been sticky, but all of a sudden it's been easier to fill positions. The JOLTS has been falling. Atlanta wage tracker shows job switchers aren't really getting a premium any longer. I think we're seeing a labor market that's tight, but not one that's adding to an inflationary cycle. I mean, if wages stay at 3.5%, even 4%, that's consistent with 2% inflation.
So you don't think the Fed will have to respond to the fact that we've seen energy prices tick up? And I mentioned what that's going to do to the headline inflation. I know they're more focused on the core and the underlying metrics, but doesn't the oil price rise feed into the rest of the economy and the rest of the price dynamic?
It's a bit of an irony, right? Because the reason core was introduced was because food and energy were volatile, and the Fed didn't want to be responding to those. But you're right in the sense that we are hypersensitive to any inflation risk right now, and the public is, and the White House is. So oil does matter. But to me, is oil going to cause house prices to soar? That's your real services question. Remember, housing and just cars is 57% of CPI, right? So, if oil prices cause home prices to jump, then the Fed's got a problem.
Yeah, monster categories. Hey, finally, Tom, I wonder if you think the bulls should be heartened by the way equities held in a wave of IG supply this week. And I wonder if you also think IPOs, if they are successful, take any oxygen out of the room in the coming weeks.
Yes, I mean, it was good earlier this week because we did have a ton of issuance, and that was a lot of supply, and rates responded. But the 10-year is sort of cooling off now. I think that's at least a green shoot. IPOs are certainly really important because it injects a lot of confidence to both retail and institutional investors, because institutional investors often get exposure to a sector by buying an IPO and really knowing the company, and it gives them conviction. So if the IPO market opens up, I think it's very supportive of a year-end rally.
Thanks, Tom. Appreciate it.
Thank you.
Tom Lee, bullish on tech. As we head to break, here's our